Hey everyone, welcome to this DeFi Nation interview. My name is Clayton Roche. I'm the head of DeFi with Masendo, joined here with Tom Howard, who's the CSO and co-founder of Masendo.
Hey, how you doing, everyone?
And I'm very excited to be here with Kain Warick. He's the founder of Synthetix. Synthetic assets are something in the DeFi space that are new and very interesting to people, and really excited to learn more about them. Thanks for joining us, Kain.
Yeah, thanks for having me, guys.
Yeah, maybe you could just start out by telling us a bit about kind of what some of the benefits are that people could expect to gain by using your platform.
Yeah, for sure. I think the main benefit of the platform, or kind of the intention behind the platform, is to give people exposure to a variety of different assets on Ethereum without needing to actually hold the underlying asset. So, a couple of examples of things we have: various different fiat currencies. British pound, Australian dollar, US dollar, etc. And then we've got things like commodities, so gold and silver. A number of different cryptocurrencies. We've got some indexes, and essentially the idea is that you can just hold a single token, and that token will track the value of some other asset that may not be on Ethereum.
Okay, so if I'm understanding correctly, I'm able to sort of capture the value change of gold, for example, without ever actually owning any gold. Instead, I'm owning your native token. Is that right?
You own kind of a derivative of our native token. So our native token is the collateral, and then there's debt that's issued against that collateral or minted against that collateral, and that debt tracks a price feed of gold, right? So
okay.
You can just hold that gold token, and if gold goes from 1,200 USD an ounce to 2,000 USD an ounce, then you get that price appreciation.
Great. And then one other thing I wanted to make sure we talked about early on for people is, as I understand, there can be some benefit in holding your token and staking it on the platform to provide collateral. Is that the right way of thinking about it?
Yeah, that's right. So essentially you're providing a service to people who want this exposure, this synthetic exposure to different assets. So you provide the collateral, you lock that collateral to issue debt, and then you essentially take on this pooled counterparty role with all of the other SNX stakers, and allow people to have access to these different assets. Now, obviously, there's risk to that, but there's rewards. So you get fees, you get staking rewards, which is paid in the native token, but you take on the risk of all of those trades in the network.
Okay. And so, Kain, before we hit record on this, I was asking you some questions that I just personally had about how this worked. And so like one of the big things as I was reading through your light paper is you explained that people can buy synthetic assets without any slippage. So somebody could buy, maybe 10 Bitcoin and maybe the order book, or maybe 100 Bitcoin, and maybe the order book on an exchange would cause a lot of slippage, but with Synthetix, you wouldn't face any slippage. And so I was having a little bit of trouble wrapping my head around like how that's possible. It seems like a really useful benefit. So maybe you could explain how that's possible.
Yeah, for sure. So I think it is kind of counterintuitive, right? Although I think people kind of get used to this idea that there's slippage in trading when you're trading with counterparties. But in the real world, we're not actually that used to it, right? Like you're used to just being able to buy as much of something as you want at a certain price, and potentially even get a discount. If you go in and say you want to buy 1 million cans of Coke, it's probably going to be cheaper, right? But when you're trading and you want to buy 1 million units of something, it typically will get more expensive. And vice versa. If you want to sell it, then you'll have to offer a discount. The reason why we can provide essentially infinite liquidity is that we're not creating a sort of spot market. You're not actually trading with people. We're just taking a price feed from the spot markets. So if the price of Bitcoin is $10,200, we basically give you the right, by holding debt, to reprice that debt into some other asset. So if you're holding synthetic US dollars, you can reprice that debt into synthetic Bitcoin at the current spot rate. And there's no limitation as to how much you can actually trade, or how much you can convert. However much debt you've got, you can convert.
Okay, and something else that we had talked about was what else did we talk about? So I had asked you about this issue with slippage, and then the other bit was the counterparty, right? So the example that I think of is like, let's say I bought synthetic Bitcoin for $5,000, and the price goes up to $10,000. Well, I've profited $5,000, and maybe I choose to sell at that point. So like, where is that money coming from exactly?
Yeah, so in a traditional market, there'd be someone who had sold you that Bitcoin, who could have profited, and it's their loss, right? And your loss and their gain, or vice versa, balances out. In this system with pooled counterparties, the SNX holders take on the risk of the debt movement. So your profit would be increased debt in the system. So the total debt would increase, and that debt would be spread proportionally across all of the people who were staking the system. So essentially what you're looking for is a large enough sample size of people that are holding different assets. Some people are long, some people are short, so that the overall debt pool is kind of market neutral. Which isn't the case right now. The overall debt pool is fairly long. Most people are long biased into ETH and Bitcoin and various other cryptocurrencies. But over time, we're going to introduce some new functionality to help to balance that out, so that the system is market neutral, or as close to as possible.
I see.
And so SNX as an asset has been pretty interesting to myself and some other people that I know. When you're staking SNX right now, the rewards for staking, or basically providing liquidity into your system, are pretty generous at the moment. So I know a bunch of folks are kind of doing that, staking their SNX, earning some pretty decent interest rates. I'm wondering, where in the system does that interest come from? If the SNX holders are earning, I think, what are the rates right now? They're like,
it's about 75%.
75% yearly.
Yeah, about 75% yearly. So that's essentially, you can kind of think about it as similar to like a block reward, or validators being paid in the native token to provide a service, right? So in the early phases of the project, we need to bootstrap that activity. And so when we launched, we had a fixed supply token, and there wasn't a huge amount of incentive to take on this risk to help to bootstrap the initial liquidity, get debt into the system, and provide that service. And so we made a decision in late 2018 to change the monetary policy and create an inflationary supply token. And so, initially there's a fairly high inflation. It halves for 4 years. And so it goes from 100 million initially to about 250 million over the course of 4 years. So, the idea being that as we taper off inflation, we ideally want the actual exchange fees to be providing kind of sufficient incentive to provide the service as an SNX holder.
So, Kain, I'm listening to this, and a lot of people in DeFi Nation group are excited about lending, and what draws people in is the ability to hold a stable coin like DAI and lend it and earn a fairly healthy interest of, in this last few months, it's ranged anywhere from 8 to 18%. Mm-hmm. Well, you just told me that I can get 75%. So I'm kind of curious if you could explain maybe what some of the risks are, the considerations somebody needs to make before they just rush out and pull all their DAI out of these platforms and buy SNX tokens. What are the
there's no such thing as a free lunch, right? So it's risk reward, right? There's a reason why that interest rate or that inflation rate needed to be so high, which was in the early phase of the project, again, to just offset the risk to being a staker and taking the risk of the debt. And the potential that if everyone's long and the price of ETH triples overnight, that you could potentially be in a situation where there's more debt in the system than there's actual collateral to back it. And so it's a much higher risk activity than lending on Compound or something like that, right? You know, and lending on Compound is not a risk-free activity, right? There's been some discussion. I think, you know, various people have asked questions about, you know, why is there such a large delta between lending DAI on Compound and, say, you know, putting it into, you know, a money market fund, right? And the reality is it's a whole bunch of reasons that are being priced in. And then when you know, add even more risk on top of that, you know, in order to kind of incentivize people to stake in SNX, you know, there's a higher risk and higher reward. It's kind of, you know, market determined to a certain extent.
I see.
And the 75% interest, that's 75% priced in SNX token, not priced in US dollar, right?
Yeah, correct. Yeah, it's 75% of the total supply in the first year in SNX.
Right. And so just to clarify there, like the SNX token is not a stable token. It's more like an asset token, like Ethereum or Bitcoin, right? And
Correct.
then
Yeah.
you're generating the tokens that are pegged to other values that, you know, might be stable, like a US dollar.
Yeah, by locking that collateral. So, you know, the total network value is around 70 million, give or take, of SNX, and we've got about $7 million worth of assets, of synthetic assets of various different denominations. So Bitcoin, you know, Ethereum, USD, etc.
So for the people that maybe don't want to take that SNX asset risk, is there a good lending opportunity for them if they want to keep things pegged to US dollar and kind of be earning in US dollar?
So there's a few different ways that you can interact with the system and potentially, you know, get some kind of a yield. You know, one way is you can just trade on the system, right? So, you know, you can convert into synthetic ETH or synthetic Bitcoin and get exposure to Bitcoin on Ethereum without, you know, leaving Ethereum, right? Without having to hold the asset somewhere else. So that's one way. But, you know, obviously that's taking the normal kind of risk that you have in holding any crypto asset, right? The other way is to stake and, you know, take the risk of, you know, being a counterparty to all of these exchanges that are happening in the system. But we also have some other incentives. So there's an incentive to provide liquidity into the Uniswap synthetic ETH pool. And that's also paid in SNX tokens. But the yield on that is pretty high. You know, it does vary week by week, but you know, I think there's been some calculations recently that even annualized, that's about 30%. Again, it's still a high risk activity because, you know, there's potential that something could happen to the contracts and, you know, the ETH could be drained out of that Uniswap pool. But, you know, if you want to kind of have I guess, a more passive engagement and earn some SNX, that's kind of the middle ground, I guess, of yield in the system.
So, Kain, in that second example, you wouldn't be exposed to the risk of the increase in debt amount?
Correct.
Okay.
Yeah. You're not exposed to the increase in debt. You're only exposed to sort of smart contract risk, you know, to kind of mechanism design risk in the system that somehow the system becomes under collateralized and the value of the synthetic ETH drops because you're obviously holding that asset. You're also exposed to just the ETH price because you're now holding both ETH and synthetic ETH. So you kind of doubled your exposure to ETH. So, you know, if ETH goes down, then on a USD basis, you're gonna lose something. But conversely, if it goes up, as it has, you know, over the last few days, then, you know, you're gonna gain. So, you know, it's, again, if you're kind of passively holding ETH, it's not a bad yield opportunity, but obviously there's a whole bunch of risks. And, you know, probably the best place to kind of understand some of those risks and different strategies is in our Discord. We've got a bunch of kind of sophisticated traders and strategists that have different kind of yield approaches. And they're more than happy to discuss kind of how to extract some yield out of the project.
Sure. I've popped into your Discord. You have a lot of very passionate community members in there and a lot of like very clever strategies going on, you know, people that have really worked out all these different angles.
Yeah, I think, you know, when you give people a highly complex system and, you know, they're sort of drawn to complexity, it does create, you know, some pretty powerful network effects. There's some very intelligent people in the Discord community that spend a lot of time thinking about how to, best extract as much as they can out of the project. So
sure.
Yeah,
that's great.
Yeah, I've been like most I've noticed that the most with the SNX community is like people are really thinking very intelligently about kind of like, I would say, these decentralized finance networks, and I think Synthetix has been a great playground for a lot of these different like thinkers to come in and try different ways of making money, or even just thinking about I mean, the team, your team have iterated constantly over the past 2 years, responding to different constraints and roadblocks that you've discovered along the way. So I think that's been really cool, just kind of like pushing forward the edge of decentralized finance structures.
Yeah, for sure. I mean, obviously there's trade-offs there as well, and that's been
Yep.
discussed recently about, the trade-off between being able to iterate quickly and having some level of centralization. But I do think that there is this kind of draw of the complexity of a system like this, where people get excited and they really want to dig in and they kind of go down the rabbit hole. So it's obviously great to see people that are super passionate about the project.
Yep. And yeah, I mean, to address that like iteration versus decentralization topic, I've noticed that there's a bunch of people who are quite loud about that, but it doesn't seem like they're the ones who are putting their money where their mouth is. For instance, there was a lot of people who were upset over, Compound's ability to upgrade their contract and kind of have some backstops in place in case there's some sort of incident, such as the DAO hack. But when you look at how much money was deposited into Compound before and after, nothing changed. Like the people who actually put their money where their mouth is didn't take out their money because of a new risk that, or what they perceived to be a risk. It was the people with big mouths on Twitter who were complaining about it, but like, it seems like everyone's really okay with that.
Yeah, I do think that these projects are still so early, right? Compound has $150 million worth of assets, but there's 3,000 or 4,000 people that are actually lending that, and if you look at where the majority of those assets are coming from, it's probably less than 500 different people that are kind of participating. So those people understand the risks. They may not understand every single risk and know every single intimate detail about exactly how the mechanism works and the trade-offs and all those things, but they're not kind of blindly depositing funds if they're holding large asset bases. So I think even recently with us, where there was a bit of kind of controversy around, again, our ability to upgrade the contracts and how we handled some of the front running. Everyone in the community, it was priced in, so there was like no impact at all, right? To it wasn't news. This has been kind of well known in the community for several months. So the people that are actively participating are fairly engaged. Is kind of the thing that I've seen with projects. Whether it's you guys or Dharma or Compound or Uniswap. Like you go into the Uniswap Discord and like people are like deeply thinking about all of the trade-offs, and they're not really just kind of throwing money in there and walking away. They tend to really understand what the trade-offs are. So I think that's a good thing, but obviously we need to get better at communicating that as a wider group of people joins the party.
So Kain, I'm interested to zoom out a little bit from the crypto specific space and talk just about Synthetix. In your light paper, you explain that the benefits include access to people who might not be able to access the assets otherwise, and also just like a lower friction. You can change between different asset types without having to enter different marketplaces, etc. I'm just curious what you see as the future of synthetic assets, what kind of the major value proposition is, maybe who in the world you see them helping.
I mean, I think that Synthetix is such a broad category, right? You've got things like synthetic futures, you've got synthetic options strategies, you've got weird kind of crypto synthetics, like BMX's perpetual futures, and there's all kinds of different synthetic assets, right? And the synthetic assets that we enable on our platform are also, kind of different to traditional finance assets and the way that they're structured. But, essentially what we're trying to do is allow anyone on Ethereum to have exposure to any asset that there is a price feed for. So, if there's a spot market somewhere and we can get access to that price feed, then we can give someone exposure to that asset on Ethereum. So that's every commodity, every equity, all of the indices around the world, fiat currencies, etc. And so if you imagine someone who's in, an emerging market in Southeast Asia, for example, which, I know you guys know that market well, they may be able to get access to a broker, in the US to buy, Uber shares on the IPO day, although, to their detriment, obviously, but, they may be able to do that, but the vast majority of people won't be able to, right? And so the idea that you could open up access to every single person who can access Ethereum, and that's rapidly becoming everyone with a smartphone, as we kind of solve some of the on-ramping problems, which again, I know you guys are well acquainted with that, that process. As we solve on-ramps and we make all of the wallets available and all of this infrastructure available to support emerging markets, anyone in the world on the same day will be able to access without a broker, something like the Uber IPO.
Wow.
And I think that in terms of kind of enabling people to get exposure to traditional finance markets is kind of pretty incredible. And that's before you even talk about some of the other, I guess, more exotic assets and indexes and things that you can build, by combining different assets and different traditional instruments. So just access in and of itself, I think, is quite powerful, and that's where we sort of see this going. But there needs to be, I guess, an immediate utility that you can deliver, and that's why we were sort of talking about crypto traders and people who want to trade crypto futures and things like that. That's where the immediate demand is going to come in the short term, and those people will help kind of pave the way to this wider adoption.
Yeah, absolutely. We have the same kind of thinking at Macendo as far as like who our initial users are going to be and the people who are going to help kind of battle test everything on the outset and kind of make it really user friendly for people who aren't interested in hanging out in Discord communities for 4 to 6 hours a day, right?
Yeah, and look, and rightly so, right? Like,
yeah.
I don't think it's prudent for anyone right now, to put their life savings into a sort of untested crypto project of any kind, right? And so I think it's really important that we kind of shake out a lot of these things and really kind of harden them and make sure that they're as robust as they possibly can be before we let people start putting kind of critical funds, I guess, into these systems. When it's speculative funds and people, it's risk capital, I think that's fine. And people can kind of measure their own risk. But when someone's taking their life savings and trying to put it into equities or indices or bonds or something like that, traditional finance instruments, we need to make sure that it's going to be secure.
Absolutely. And the people that you talked about who are discussing all of the nuance of the risk and whether or not having things perfectly decentralized is important, like those are the people who are really making sure they understand the risk of what they're doing, as opposed to people who might just hear, 75%, and then like dump their money in or something, right?
Yeah, exactly.
We definitely need to have this stuff refined before more casual money kind of comes in.
I agree.
Yep.
For sure.
Well, really appreciate you coming on with us. Hey, Tom, did you have anything else that you wanted to ask Kain before we wrap up?
No, I think that's all from me.
Okay, great. Kain, it's really exciting. Is there anything else that you wanted to tell us about Synthetix or something you'd like to leave people with before we sign off?
I think the only thing is just a call out to say we're currently doing a vote within our Discord to choose the kind of composition of a DeFi token index that we're going to launch in the next couple of weeks. So, you'll be able to potentially, have access to a basket of 8 or so different, DeFi tokens and in a single token wrapped up. So if you're interested in that and you want to have a say in what kind of goes into that basket, then jump into our Discord and come vote.
Wow. Okay, that's interesting.
That's super interesting because of the that NASDAQ launch where there was a bunch of like kind of like not really DeFi tokens included in that index. I've been thinking about how to do that myself. I'm wondering if just kind of like pegging something to the collateral or like the funds locked up in DeFi on the DeFi Pulse homepage, just like pegging something to that number, to that price feed.
Yeah. Well, I think, UMA obviously is a different approach to synthetic assets, right? But it has the potential to create, even more exotic instruments than we can kind of support. So, some combination of, like an UMA style token plus a DeFi index, I think would be, quite interesting, and people would be interested in having exposure to that for sure.
Cool. Well, I will direct people to participate in that vote about the index. I'll be curious to hear how it plays out.
Yeah, come and show your favorite DeFi project.
There you go.
Awesome.
Thanks so much, Kain. I look forward to hearing what comes out of Synthetix next.
Awesome. Thanks very much.
Cheers, Kain.
See you guys. Bye.
Bye-bye.